Hi everyone, let's go over my Elliott wave scenarios on the Bitcoin chart, starting with the lowest probability Elliott wave scenario because I like to explain the why behind it. So here on the daily time frame, you can see a 1, 2, 3, 4, 5 impulse structure. 3 is finished, looking for a bigger flat in 4 and then continuation to the upside in a wave 5. The reason why the probabilities are lower than the other scenarios is because of your wave B. Now I can explain it by going to the 4-hour time frame where you can see the flat in a little bit more detail. So here we have an expanding flat, 3 wave A, 3 wave B, and a 5 wave C to the downside. Now there's 3 things you have to keep in mind. First of all, you can see the 1.618 here on my chart, which is taken from the start to the end of your wave A. Now the 1.618 is a rare target for a wave B in an expanding flat. Your most common target is actually below here, the 1.236 to the 1.38 pulled from this high to the low. But as you can see, the 1.618 is touched and we are moving above it. Now that lowers the probabilities for this particular scenario. And you may be thinking, but wait, we also have a 1.236 and a 1.38 here, and that is correct. But these fips, the upper two, are pulled from the high to the low of this quick move down. Because alternatively, one might think, okay, well, I count this as a wave A, this is my wave B, and I look for a wave C down. However, in that particular scenario, your wave B here is over 13 times longer in time compared to your wave A, which also is incredibly rare. Now, time is not an invalidation, right? But it does have an impact on probabilities, and this is something we do not like to see. And then finally, in both of these flat scenarios, A, B, C, or counting A, B, C, your wave X in both cases hit the 0.7 Fibonacci, which is uncommon / rare for a double zigzag. Because preferably in a double zigzag, you create a zigzag W, X, Y, where your wave X is not touching the 0.7 Fibonacci, which of course happened here. If we count from the low of A, WXY, we touch the 0.7, but also if you take it from this low to this high here, we also touch the 0.7. So that's your third reason. So there's basically 3 reasons why the probabilities aren't too great. The 2 main ones is the 1.618 touched, taken from your A here, or it is the time. If you count A, B, C, your B is incredibly long. And then as more like an extra, double zigzag 0.7 Fibonacci touched is not what you like to see. It's not an invalidation, but it lowers the probabilities. And in the end, the probabilities are the only things that we really care about. So if we then look at 2 other scenarios, which make a lot more sense, then the first one is the one you see here. And this is now your basically new quote-unquote bearish Elliott wave scenario, where in this case, you are looking for a short 5-wave impulse up here and then get a retracement. Now the price action might be similar compared to what you see here. As in, we could see a move down to take liquidity in this scenario, right? You don't want to see a big 5-wave move down. You want to see a 3-wave move down. That's the difference. But you might still come back down there to grab the liquidity. However, the count is different, and that is what is important. So in this particular scenario, you have a 1, 2, 1, 2, 3, 4. You count a 5 in here, and then after this 5, you get your 4, your range, and then another 5 to the upside, right? Now the difference here is that we do not count any flat here in an A, B, and then a wave C, right? So this is a finished corrective structure. This is a new impulse, and then you get another corrective structure. Now the common target area for a wave 4 of a higher degree, which is the blue 4 here, is the price action of the wave 4 of a lower degree. It's a guideline, not a rule, but it is common for a wave 4 to retrace to the price action of a wave 4 of a lower degree, which is the range that we have been in for a while over here. Now, if you then go to the 1-hour time frame and we zoom into this structure, right, then arguably your quote-unquote bearish scenario is trying to count a finished 5-wave structure in here or a soon to be finished 5-wave structure here to the upside. So we go to the 1 hour and you can see the polylines as well here on my chart. So the first count you see is, first of all, finished corrective structure at this low. After then WX triangle in Y, finished here. This is your 1 to the upside. And if we want to count a finished impulse to the upside, then this would be the way to count it, with this wave 2 moving to the right here. So we then have our wave 1, 3 wave 2, 382 touched, minimum target for wave 2 is touched. And then you look for your 3, 4, 5. Wave 1 and wave 4 have no overlap, which is what we like to see. Wave 3 here is longer than your 5. That's also good because your 1 is longer than 3, but 3 is not allowed to be the shortest, right? And then you have your final leg up in a wave of 5. Now this is a little bit forceful because there's two things here that do impact the probabilities negatively. First of all, this is your wave 4 and this is your wave 2. Wave 2 is bigger than 4, while most commonly 4 is bigger in time compared to 2. And second, if we look at the volume here of this move towards the upside, then it is most common for a wave 3 to have the highest amount of volume. But in this case, you can see that your wave 1 here has more volume, right? And also, if we look at the latest structure to the upside here, then the volume is in the high. So we moved up, down and up, and internally here your wave 3 has a lower amount of volume than your wave 5, which is not what you like to see, as most commonly wave 3 has the highest amount of volume. So if we compare 3 and 5, preferably you would then do this, put your 3 up here, move your 4 to the right, and then you get a bigger 3-wave corrective structure in 4, and then move up once more for your 5. And after your 5 is finished, preferably making a new high on a lower amount of volume, that is when you want to see a retracement to the downside. So it makes more sense to still take out this high here because of volume, right? Because the highest amount of volume is currently in the high, and also your wave 4, right? If we count it like this, your wave 4 is shorter than 2, but preferably your 4 is longer than your wave 2. So therefore, if we count it like this, and we then look for 3, 4, and still a 5 up. I might actually have to remove the polylines here for clarity. Then you actually want a bigger sideways structure in a 4, and then get that last leg up in a wave of 5, where the target for your wave 4 here is going to be this 4, because now you count 1, 2, 3, 4, 5. Now, of course, this also has some interesting arguments, because counting this as an impulse here is very, very tricky. But besides this, like, you know what I mean. In this particular case, you actually want to make another high. The probabilities would be higher for price to still take out this high here, preferably if we want to count this as a finished 5-wave structure, because 4 is shorter than 2. And you have the highest amount of volume in your high compared to your 3, right? 5 and 3. More volume in 5 compared to 3, which is not common, okay? If we then go back again to the daily time frame, then on the daily time frame, your actually more bullish scenario is what you see on the chart here. So here we then have our 1, 2, 1, 2, 3, 4 is finished, and we look for a bigger impulse now, right? So everything that's happening here locally to the upside are multiple 1-2s, and we're looking for a breakout to the upside. Actually quite similar to the price action that we had when price was at 33 to 39k. You may remember this if you were in the markets at that moment in time. So here we have this range, right, grinding to the upside. It looks very similar compared to what we have now. And then if we compare where we are now to this section here, then we would be somewhere over here, right? And of course, in your most bullish scenario, which is the one I have on my chart and show to you again in a second, you're basically waiting for this. And then eventually you get your range. Of course, you always get a range after a push, but you're still looking for price to move to the upside further compared to your quote unquote bearish scenario that I just covered, where you end and then start a bigger range already. And if we then go back to the current price action, then this is what you're looking for. So here you have that range is similar to what we had at 35K, right? And you look for a bigger move towards the upside. So you have a 1, 2, maybe a few more 1, 2s here, and you look for that push, right? Invalidation is 100.6K. You don't want to see a market structure change really moving below 102.6K would already negatively impact the probabilities for this scenario. But as long as you do not change local market structure, I mean, it doesn't really make sense to think about quote-unquote bearish scenarios where you go back into a much bigger range again and bigger drawdowns, right? So in this particular scenario, you have your 1, 2, 1, 2, 3, range finished 4, look for continuation to the upside, finish 3, get another big range in 4, another new move to the upside in a wave 5. And if we then go to the 1 hour time frame, then before I actually talk about the impulse up, I like to show you the comparison with the range that we had at 33 to 39K, which is this. The pink line is a bars pattern taken from the range at 33 to 39. And you can see how nicely it overlaps. Now, price doesn't repeat, right? It rhymes, it works till it doesn't, right? As everything always does. But at least there are some lessons to be learned from the range there compared to what you have now. So I can definitely recommend also to compare those two ranges, because you can see if you put them next to one another, they both channel very well, right? They both had a final bounce here and then move up impulsively to the upside, creating higher highs, higher lows. The structure, right, of the pink line never changed. It was always bullish market structure. Of course, you can have a flat structure here, right? In the range at 33, 39. This can be counted as an A, B, C. It's no problem to have a flat, of course, A, B, C, and up. The market structure is this low, right? You don't want to lose these lows here. That's important, right? You want to keep that market structure alive. But you can see the synergy. And something, if you would compare these two ranges, something that you see as well is that as price moved up back in the day, these highs here had the highest amount of volume. So the volume was all the time highest in the peak, right? Which is generally not something you want to see, as like you won't count it a 5 because preferably wave 3 has the highest amount of volume. But I already spoke about the volume here, where you can see if I remove the bars pattern, this high and this latest move as well, highest amount of volume, right, in the peak here as well, and here as well. So you know, a little bit of a, I suppose, a synergy between what we had then and now. And then again, price doesn't repeat, but it can rhyme. It's good to keep in mind and something I like to share. So basically what we are looking for in that more bullish scenario is continuation to the upside, right? We don't want to change the structure. We can keep it very simple. I could have made this video 1 minute and be like, hey guys, as long as we don't change structure, as long as we don't move below 103 what is this, 3K, or preferably 102.6K, right, 100.6K, you're looking to the upside, no? And Elliott waves is not necessarily about sniping highs and lows, even though in ranges we are very good in doing so. But in this case, you're still in a bull market. Price is moving to the upside, higher highs, higher lows, right? We still have bullish CVDs coming in as well. As long as you don't change structure, there's not really a point in thinking anything else than you know, taking out this high and then take it from there, right? Take out this high, yeah, potential for a move down, but then again, need to change the structure. So this is all about risk management, knowing where you're wrong, knowing the invalidations, knowing when the probabilities are higher to get a bigger drawdown and get a bigger retracement to the downside, right? That is what Elliott waves here locally gives you, because your bullish scenario is quite simply a bunch of 1-2s, and you continue towards the upside. You're looking for that acceleration to the upside, right? You want to see that wave 3 and then go sideways in a bigger wave 4, preferably, of course, the size of your wave 2 or longer, right? So that is something we have to keep in mind. Now, I already mentioned CVD shortly. Yes, we have a bearish CVD, but you can see the bullish CVDs as well. And we are in bullish market structure, so therefore bullish CVDs have a higher priority. Only if you change the market structure, that is when the bearish CVDs become very, very interesting. Of course, a bearish CVD divergence might give you the opportunity to snipe a high or snipe a low, but preferably, at least based on my statistics, and I've used CVD for a very long time now, it is generally better to use the CVDs that are in the direction of the trend till they don't, right? So keep that market structure alive. Bullish CVDs are very interesting. Yes, we have a bearish CVD. If we do move down, change the structure, and then we get a bearish CVD again, that's interesting. That's an interesting potential short position at the moment, price moving up, and we have some bullish CVDs. The news Tuesday, today, December 17th, 2:30 p.m. Central European time. We have some high impact news here, so make sure you trade safe because it might increase the probabilities of volatility on the chart. And of course, you got to be careful with volatility. And if you then look at the probabilities of the different scenarios here, then generally counting an impulse to the upside here makes a lot more sense than trying to force a flat in here, right? So your quote-unquote bearish scenario being the flat, I suppose, counting an A, B, C or A, B, C, much lower in probabilities because your wave B either moved above the 1.618 Fibonacci, which is very rare, or it's 13, 14 times the length of your A, which is also very rare, right? Besides a double zigzag hitting the 07, which is also not what you like to see. So it makes a lot more sense to now count this as an impulse and have a completely finished corrective structure here, right? Now with this in mind, knowing the highest volume in the local 1 hour trend is in the latest high, probabilities from an Elliott wave point of view are higher to still take out that high again for higher prices, because preferably the highest amount of volume is in a wave 3, not a wave 5. Only if price changes structure can we consider a finished impulse to the upside and deeper drawdowns moving back into another big range in a wave 4. Looking at the polylines on a daily time frame, which basically summarize the potential price section, then you can see that in both cases you are still looking for price to move towards the upside. The main difference is made over here, where of course in the more bearish scenario you are looking to finish a 5-wave impulsive structure and then get a 3-wave move down instead of getting acceleration to the upside, and the green line really would actually be a lot higher. And then on the 1 hour time frame, the probabilities here are higher for the green line or the white line. In both cases, you take the high and then of course you observe. Please be mindful of a potential flat. Flat is actually bullish because then you afterwards still want to take out that high. As long as price doesn't change market structure, you're basically looking for moves towards the upside. So that being said, I hope that this video was helpful or valuable to you. Please check out the CVD indicator video, the best indicator out there in my opinion, or the Elliott Wave educational playlist to help you understand more about Elliott waves. Thanks for watching and subscribing, and I hope to see you at the next one. Bye bye.